Technical indicators for trading charts are a dime a dozen these days. With the thousands we now have access to, it's amazing how many ways we've come up with to fit a line to a dataset. Popular indicators come and go, but few are as old and as battle-tested as the Ichimoku Cloud. Let's figure out just how useful this most legendary technical indicator ever drawn can be in this episode of Doji Show. This episode of Doji Show is brought to you in part by PineBot. Visit pinebot.com today for access to the world's most advanced algorithmic trading bots. Put your portfolio on autopilot with PineScript-powered AI. Long and short, bull or bear markets. Browse the strategy marketplace and subscribe to user-created bot strategies. Then, load them up in our easy-to-use bot commander interface. Deploy the best strategies against the market for the win today at www.pinebot.com. When I first started analyzing markets, I had a sort of visceral reaction to most of the indicators I was first presented with. I definitely remember struggling to appreciate any of them. That is, of course, until I came across the Ichimoku Cloud. Ichimoku was the first trading system that I thoroughly learned to employ. Though no indicator is perfect by far, the Ichimoku Cloud did help me, and I still appreciate it for that. Like many awesome innovations in technical analysis for trading, the Ichimoku Cloud originates from Japan. The original name of the indicator is the Ichimoku Kinko Hyo. Ichimoku meaning one glance, Kinko meaning equilibrium, and Hyo meaning chart. So the altogether loose translation would mean one glance equilibrium chart or balanced chart at a glance, something like that. The inventor of the Ichimoku system was a Japanese journalist named Goichi Hosoda. His friends knew him as Ichimoku Sanjin, which translates as what a man in the mountain sees. Goichi mostly reported on the rice markets. He understood how price moved and how it would react around certain areas of a chart. He discovered that price followed certain rules, and the reactions were due to what we now know today as support and resistance. His goal was to create a technical indicator that could encapsulate the market at a glance, so that one could take one look at a chart and instantly be able to analyze it in a short period of time. Goichi began his work just before World War II, so he didn't have any computers available to him to do automated backtesting or anything like that. Everything had to be done by hand. What he did have, however, was a large group of students who spent over 20 years manually backtesting his formulas. What he accomplished during that time is an impressive feat, even by today's standards. Hosoda's contribution came in the form of a book that he published in 1969. When he released his book to the Japanese public, it rapidly became the most frequently used indicator in all the Japanese trading rooms, as it is still today. Though very popular in Asia since its publication in 1969, the Ichimoku system didn't appear in the Western world until the 1990s. This was largely due to lack of translation of Hosoda's work. To understand the Ichimoku system, we first have to understand the philosophy that Hosoda built it upon. Hosoda believed that the market is a direct reflection of human group dynamics and behavior. He felt that human behavior could be described in terms of constant cyclical movements, both away from and back towards equilibrium in their lives and interactions with reality. Each of the 5 components that make up the Ichimoku Cloud system provide its own reflection of this equilibrium or balance. Through Hosoda's Ichimoku system, one can view the market as a constant flux between chaos and order, of course reminiscent of yin and yang. The Ichimoku system is comprised of 5 elements, 6 if you count every line. First, we have a line called the Tenkan-sen. The Tenkan-sen is calculated by the highest high plus the lowest low divided by 2 for the past 9 periods. The Tenkan-sen is primarily used as a signal line and a minor support and resistance line. The Tenkan-sen is also known as the turning line or the conversion line. It is an indicator of the market trend. If the Tenkan-sen is moving up or down, it indicates that the market is trending. If it moves horizontally or flat, it signals that the market is ranging. Next we have a line called the Kenjin-sen. The Kenjin-sen is calculated by the highest high plus the lowest low divided by 2 for the past 26 periods. This is a confirmation line, a support and resistance line, and can be used as a trailing stop line. It's also known as the baseline. The Kenjin-sen acts as an indicator of future price movement. If the price is higher than the Kenjin-sen, there's a good chance that it will continue to climb higher. If the price is below the Kenjin-sen, there's a good chance it will keep dropping. Next we have a line called Senkou Span A. Senkou Span A is calculated by the Tenkan-sen plus the Kenjin-sen divided by 2, plotted 26 periods ahead. Senkou Span A is also sometimes referred to as Leading Span 1. Senkou Span A forms one edge of the Kumo, meaning cloud in Japanese. If the price is above the Senkou Span, the top line serves as the first support level, while the bottom line serves as the second support level. If the price is below the Senkou Span, the bottom line forms the first resistance level, while the top line is the second resistance level. Next we have Senkou Span B. Senkou Span B is calculated by the highest high plus the lowest low divided by 2, calculated over the past 52 time periods and plotted 26 periods ahead, just like Senkou Span A. It's also referred to as Leading Span 2. This line forms the other edge of the Kumo cloud. This brings us to the Kumo cloud. The Kumo cloud is the space between Senkou Span A and Senkou Span B. The edges of the Kumo cloud identify current and potential future support and resistance points. The Kumo cloud changes in shape and height based on price changes. This height represents volatility, as larger price movements form thicker clouds, which creates a stronger support and resistance. As thinner clouds offer only weak support and resistance, prices can and tend to break through such thin clouds. Generally, markets are bullish when Senkou Span A is above Senkou Span B, and vice versa when markets are bearish. Traders often look for Kumo twists in future clouds, where Senkou Span A and B exchange positions. This is a signal of potential trend reversal. In addition to thickness, the strength of the cloud can also be ascertained by its angle, upwards for bullish and downwards for bearish. Any clouds behind the price are also known as Kumo shadows. Finally, we have the Chikou span, or otherwise known as the lagging span. The Chikou span is calculated by the closing price projected back 26 days on the chart. The Chikou span is used as support and resistance. A buy or sell signal can be observed anytime Chikou span crosses price. The Chikou span can also be used as a filter to determine if markets are ranging. The Chikou span is probably the most underused part of the indicator, and many people disregard it. In explaining the Ichimoku system, most people get into the rules of the system. However, I wouldn't consider any of them as rules per se, because that can get you into trouble by blindly following them. Let's go over some of the rules for trading the Ichimoku system now and see how they can apply to everyday trading. The first rule is concerned with the Kumo cloud. This rule says that anytime a price exits a Kumo cloud, it is said to be breaking out of the cloud. Price is then more likely to keep going in that direction. If, however, the price is inside of the Kumo cloud, the market is thought to be ranging, and a rule might say that you shouldn't take a trade if the price is within a cloud. Another rule says that once the price enters a cloud, it's very likely to touch the other side of the cloud, continuing in the direction that it entered it. One trading system suggests that as soon as the price enters a cloud, you should take a position in the direction that the price is moving, since the price is likely to touch the other side. Anytime the price exits or breaks out of the cloud, we call that a Kumo breakout. This is probably the most popular signal that the Ichimoku system gives. Another popular signal concerns the Tenkan-sen and the Kenjin-sen in relation to each other. Anytime the Tenkan-sen and Kenjin-sen cross, this is called a TK cross, or a TK crossover. Whenever the Tenkan-sen crosses up into the Kenjin-sen, this is considered a bullish TK crossover. If instead the Tenkan-sen crosses down into the Kenjin-sen, this is considered a bearish TK crossover. The strength or weight of the crossover that occurs is gauged by where price is in relation to the cloud. For instance, if a bullish crossover occurs while the price is above the cloud, this would be considered to be a strong bullish signal. If, however, a bullish cross occurs while price is below the cloud, this would be considered a weak bullish signal. Likewise, if a bearish TK cross were to occur while price were beneath the cloud, this would be a strong bearish signal. And likewise, if a bearish TK cross were to occur while price is above the cloud, this would be considered a weak bearish signal. Another important signal of the Ichimoku system is called a Kumo twist. A Kumo twist occurs when Senkou span A and B cross. If Senkou span A crosses up into Senkou span B, this is called a bullish Kumo twist. If Senkou span A crosses down into Senkou span B, this is considered a bearish Kumo twist. A popular filter to use in trade setups is to consider the Tenkan-sen and Kenjin-sen in relation to price. In this way, a trade setup is thought to be forming whenever price crosses over the Tenkan-sen or the Kenjin-sen. Recall that I had mentioned that the Ichimoku system is largely about equilibrium. The Tenkan-sen and Kenjin-sen can be put to use for this purpose. The market is said to be in equilibrium when the Tenkan-sen and Kenjin-sen are closest together. As the market goes out of equilibrium, the Tenkan-sen and Kenjin-sen grow farther apart. The farther apart the Tenkan-sen and Kenjin-sen become, the more probable it is that the market will see a violent reaction, bringing them back together. You might also observe that the price tends to return to these lines. A popular method of Ichimoku is to assume that the price will always return to the Kenjin-sen. The further the price gets from the Kenjin-sen, the more likely it is to begin to return back. There also exists a little-known pattern for predicting this behavior called the C-clamp. The C-clamp is characterized by the Tenkan-sen and Kenjin-sen parallel to each other and spread far apart. This creates a shape similar to the letter C, where the further apart the Tenkan-sen and Kenjin-sen are, the more likely that they will come back together in a move of increased volatility. In other words, the larger the C shape is, the more the chart can be said to be out of equilibrium. Let's step through a classic series of events charted with Ichimoku. On a higher time frame, we see a clear C-clamp formation. We know that the chart is out of equilibrium and that volatility will soon increase. On a lower time frame, we see the price trending in one direction as the C-clamp size increases. Since we are zoomed into a tighter time frame, our Tenkan-sen and Kenjin-sen here look different. They show us the price action that's happening down below, while the C-clamp is still formed up above. We will use this tighter time frame to predict the reversal and return to the Kenjin-sen anticipated by the C-clamp. The price is currently below the cloud, so we need some confirmation before entering a trade. The first thing that happens is that the price crosses the Tenkan-sen. This is our first clue that something might happen. Next, the price crosses the Kenjin-sen. This in itself is a pretty strong signal, but we're going for a C-clamp on a higher time frame, so we'll wait for more confirmation. Price enters the Kumo cloud. From this, we know that it's likely to touch the other side. Still, we wait. Finally, price breaks out of the Kumo cloud in a Kumo breakout. This is the opportunity we've been looking for, so we enter a trade and see what happens. Our assumptions were correct. Price returned to the Kenjin on the higher time frame. The C-clamp correctly predicted that a period of high volatility was in store for the instrument. A popular method of charting markets is to use waves. One such methodology is called Elliott wave analysis. The Ichimoku Cloud system can assist the analyst in plotting these waves. Often in wave analysis of markets, discrepancies in wave counts can become apparent. This is especially often true where analysis concerns multiple analysts. The Ichimoku system can be utilized as a standard for which to count waves. To that end, the analyst need only concern him or herself with the peaks that appear above the clouds and the troughs that appear below them. Using this as a baseline, the resulting wave counts are then independently verifiable and less subjective as opposed to without the Ichimoku Cloud. Ichimoku can also be used with non-standard candlestick types. I'll now share with you a private charting methodology that I've never shared before. Rather than normal candlesticks, we switch to Renko candles. Renko candles are only affected by price action and not time. For this method, we're only concerned with the Tenkan-sen. Since Renko does such a good job of eliminating chop, we can rely on the Tenkan-sen as an entry signal. Quite simply, anytime a Renko block passes over the Tenkan-sen, we enter the trade. This method produces long stretches of tradable price movement. There are several different ways to trade Ichimoku, with many innovations that have been discovered over the years. These usually involve combining various aspects of Ichimoku with other indicators and candlesticks. Ichimoku is versatile, and its various indicators can easily be worked into any emerging trading system. Give it a try. I bet you can come up with something new. There are also modern variations on the indicator itself. I encourage everyone to search TradingView for Ichimoku and see what other people have published. Two of my favorites are Ichimoku EMA bands and Ichimoku and DD Bollinger bands, both of which you're sure to enjoy. I should also point out that some of the most impressive backtests have been performed using Ichimoku or variations thereof. Some of my favorite strategies use the indicator, or at least some components of it. In other words, Ichimoku is good for creating trading bots as well as for reading charts. For more information on that, check out Pinebot at www.pinebot.com. There you'll find a user directory where people have created bots out of Pine scripts, some of which use Ichimoku and its components. For those of you out there who are also interested in creating Pine script strategies and bot automation, I suggest using Ichimoku as a filter. The Tenkan-sen and Kenjin-sen are especially useful in this pursuit. Once you have your Pine script strategy saved on TradingView, you can then sell subscriptions to it on Pinebot, where you'll have your very own Botmaster shop. From there on out, after people subscribe to your strategy, they can then deploy it onto any crypto exchange. Of course, you don't have to sell access to your scripts and strategies. If you like, you can just utilize Pinebot to deploy your strategies algorithmically and automatically instead for yourself. There are several Pine script strategies that I keep private, both because I'm actively using them and because some of them are still under development. But the point being, anyone who signs up to Pinebot can upload their scripts, and there's no extra cost for doing this. Actually, it would save you from having to subscribe to a bot strategy, of course, if you can create them yourself. One more quick note on Ichimoku. My favorite Ichimoku system is one that's widely used by companies in Japan, but it's one that I can't seem to find much information online about, especially in the way of videos. In fact, there's only one that I've ever been able to find, and it was really short and not that helpful. This bonus method is going to be uploaded shortly after this episode, so if you're interested in learning about it, like and subscribe to be notified as soon as it's uploaded, as well as all the future episodes that we upload. I hope you enjoyed this episode on Ichimoku. Until next time, this is Tensor Tom wishing you a happy day of trading in equilibrium. I'll see you next time on the Doji Show.